Good morning, good afternoon, and good evening, everyone. Welcome to the Refinitiv Perspectives live stream. I'm Keesa Schreane.
My name is Chang, and I'm delighted to be your host for today's Refinitiv Perspectives live stream.
Not only in our consumer patterns, but we're seeing the way we work in the future continue to shift as well.
Important, and I wish those conversations had been happening sooner. But
when aligning the reporting and some of the corporate benchmarks also to the achievement of the SDGs and the Paris Climate Agreement.
And I just want to get to a question that we have here because I know that we have running out of time.
Before, sustainability was driven by mainly social activists, policymakers, but we really could not get the financial industry on board.
Companies like IMAX China, who have no debt, who have come out of this stronger, who are picking up market share, because when people emerge from COVID, guess what they crave? Experiences.
Personalized to give you the service you want. So that's something which probably was in the making, is now being accelerated.
Minds, deep learning algorithm that's enabled us to sort of speed up this breakthrough in science, which could have enormous implications for all kinds of disease, whether that's Parkinson's or Alzheimer's.
Wow, 1 year. It's our year anniversary, and thank you all so much for making it happen. It is a fantastic day today, and I welcome you to the Refinitiv Perspectives live stream. I'm thrilled to have our guest today, Jules von Binsbergen. Jules is the Nippon Life Professor in Finance at the Wharton School of the University of Pennsylvania. Jules' work focuses on asset pricing, in particular, the relationship between financial markets, the macroeconomy, and the organization, skills, and performance of financial intermediaries. Today, he'll be sharing with us insights into the progress of ESG investing, including the role of behavior change. Also, Jules was my professor during my time at Wharton with the Executive Education Program. Jules, welcome to the show.
Thanks so much, Keesa, for having me. It's great to see you again.
Great to see you as always. First of all, many people see the role of ESG investing as either in the realm of values, i.e. a moral imperative, or as potentially adding greater value, which is more economic in nature. Are you seeing now a shift toward one or the other? And if so, what's behind it?
So I think that's a great question. Let's start with that. So I think that the moral imperative part, I think, has been great to raise widespread awareness for the issue, particularly sort of from a 10,000 feet level. But I do think that now we need to, now that the awareness is there, and I think it's fair to say that there is widespread awareness at this point, I think that we need to start thinking about the exact implementation of what we're going to do with that awareness. And what also I think, because I'm a financial economist, I'm an economist, so I come at it from an economic point of view, what makes sense from that point of view. And so economics is all about trade-offs and about finding the most efficient and effective ways of getting things done. And there's still a lot of progress possible there, I think. And so I think that the shift that you mentioned, I think at least it's, whether or not it's happening is one thing, but I do think it's necessary that we sort of zoom in from the 10,000 feet moral imperative level more into the what concretely are we going to do, and do we know that the things that we're proposing and that we want to do actually work, given what we together want to achieve. And so I think that, just to give you a couple examples, so the first issue is, E, S, and G are 3 letters, which means that's a lot of things, right? It's 3 different categories with a lot of different subcategories as well. And so I think it's nearly impossible to aggregate all of these subcategories into one measure. And so one risk that we all face is if we try to do too much at once, then we may actually end up not achieving much at all. And so I think the first thing would be, let's prioritize particular goals and set concrete planning horizons for achievable milestones for things that we want to achieve. And I think that particularly on the environmental part, I think there are such things that are being done. But I think that by adopting that mindset, I think you can translate better grand visions into actual outcomes, which, by the way, is already hard enough as it is, right? So, for example, what does green actually mean? So take the example of a very fuel efficient car. Is a very fuel efficient car green because it's fuel efficient, or is it brown because it's not fully electric? So is it progress, or is it not progress enough? And so who decides that, and who sets those standards? Is a brown company that is filing a lot of green patents a brown company or a green company? So in economics, we often make a difference between assets in place, which is current activities and products that we're making or doing, and growth opportunities, which is what will the company look like in the future? So now if you have a company that right now is actually pretty brown, but if we forecast, we actually see this company turning into, with the green patents, a very green company, should we now put it in the screening as a brown company? Because we may actually be exactly inhibiting the goal that we're trying to achieve, which is that, that there's this convergence going on. And so more generally, I would say I'm a positive-minded person, so I believe very much in positive engagement, much more than negative engagement. And so I think ESG screens, they just mean disinvesting from certain firms. You can wonder, wouldn't it be better to actually take brown firms and exactly invest in them, engage with it, go to the shareholder meetings, and try to then achieve change at those companies? Isn't that a better way as compared to the negative engagement that we're often seeing today?
So let's dive into that a bit more. If we look at opportunity costs of divesting versus engagement, I'm sure there is some upside from both of those perspectives, right? Could we talk about the upside and whether the so-called downside really outweighs the upside? Could you give us an explanation there?
Well, so my biggest worry about the negative engagement is that in the end, it may not be very effective, right? In the sense that even if it is, you can say, well, I think that the negative engagement is less cost because I can just shun it. But if then also it doesn't lead to any change, then we have no cost and no benefit, and we just all stay at zero, and we could just as well have not done anything. I think the first thing to realize is to get change, a lot of work has to be done, right? And so what is the idea of the disengagement, I guess, is to say, the first thing we need to get straight is, what is the difference between primary and secondary financial markets? So secondary financial markets means that firms first issue stocks and raise money in the primary market, and then in the secondary market, existing investors trade it around between them. But it's not like the amount of money that the firm raised to begin with is going to be affected by the price at which the other investors are now trading these stocks with each other. And so the money has already been raised by the firm in the past. Now, of course, if we're talking about primary financial markets where you do, say an IPO, or even if you want to do a secondary equity offering where you raise new money in the market, then maybe we can have a little bit of an argument there. But secondary financial markets is all about other investors, at what price they exchange hands, the stocks change hands between them. And so do we think that is really going to change the real investment behavior of firms, the price at which these other investors are trading these stocks between them? Now, in fairness, there is a bit of a literature that says there's some feedback effect, which is that financial markets can give signals to firms, and firms do seem to respond to it a little bit. But if you compare that, for example, to more direct ways of trying to affect change, which I think is actually voting for proposals in the shareholder meeting and getting one thing through versus another thing through, or as a large group of consumers buying a product that you think is good versus which isn't good, or as a government to subsidize activities that have positive externalities. So externalities in economics are those things that aren't properly reflected in market prices, and somebody needs to do something about that, right? So pollution is an example of externalities. So if you tax pollution and you subsidize good activities, I think all of those are more direct ways, I think, to affect change, as opposed to trying to do it through these several steps that are required to make it happen through secondary financial markets. And so I think the question is not should something be done. The question is, what is the most effective way to get it done?
So, let's dive into that. What is the most effective way? You've laid out a big ecosystem, if you will, in terms of the stakeholders who are involved, and then the entities, obviously, that are involved. We talk about consumers, we talk about the corporations themselves, then we talk about institutional investors, but then retail investors play a role too. What solutions are the most effective, and how do these different entities and stakeholders play a role? What is the role that they each should play?
Yeah, so I think that there are two approaches to trying to get change done, and I think that one is more successful than the other. So one is, I do think that raising awareness is important, and so just for the purpose of raising awareness, the label ESG investing can help with that, because it makes people aware of what's going on, and that then could potentially lead to behavioral change, in the sense that people engage differently with products, or with pollution, or with other goals that we have in terms of ESG. But I also think that the most effective way of affecting change, I think, is through technological innovation, not through behavioral change. And so it is true that there's a literature on nudging, which means that, if you nudge people in the right direction at the right time, you can actually somewhat change their behavior. And there's quite a bit of psychological and economic research on that. But that is going to be different than trying to affect major changes, which is what I think is necessary in terms of the problems that we're facing here. And so one great example that I think is the example of whale oil, right? So whale oil was this product that was used for oil lamps and for soap in the 19th century. And so, as you can imagine, the fact that people were hunting for whales for the purpose of this oil wasn't particularly good for the whale population at the time. Now, the question is, what do you think, to solve that problem, what would have been the most effective way to do it? Well, so you can say, well, we're going to make whale hunting illegal. Well, that will have some effect, but if the economic benefits, you have the risk that the price will only go up even more, because it's now an illegal good, and therefore you get even more whale hunting anyway, right? So it's a possible strategy, but there's a trade-off, so you need to think about it. So that's one. Another strategy could be to say, well, suppose that I could disinvest from all the companies, and I no longer hold their shares from the companies that do the whale hunting. Do you actually think that those companies will stop whale hunting just because you are no longer holding their stock? In the end, maybe it's possible, but in the end, what was the solution that really did it? It was that, of course, there was innovation, technological innovation, that just produced a cheaper alternative to whale oil, and therefore within a very short period of time, whale oil was competed out of the market as an economic alternative. And it is argued by some that this actually saved whales from surviving, from extinction, just because this new alternative was introduced. And so in that sense, I think that changing people's behavior, while it only goes so far, you can try it. You can push it a little bit in the right direction. I think for major changes, I think in human society have often happened because of technological innovation. And so I think if we can all focus on that, I think that would be better, as opposed to focusing on these other things. We only have so much attention and so many resources that we have. And so thinking clearly about what the most effective ways are of solving the problem, I think, is important, so that we make good choices in terms of how we solve them.
So I love that you mentioned resources and looking at the resources that we have, and including technological innovation. I know that some people believe that the rate of change, particularly as it relates to climate change issues and how ESG investing can impact that, the rate of change of one country or one region should definitely be the same rate of change with the other region. So rates of change would need to be parallel and need to be the same. But we talk about resources, we talk about developed versus emerging. Could we speak a bit about the expectations that maybe society has around how developed countries should be addressing the issue, and emerging countries that maybe have fewer resources should be addressing the issue? Do we see a double standard there? Do we see that people are being mindful and understanding that two different regions may not be able to address this issue in the same way? What are your thoughts there?
No, I think that you have a point there. So I think so I'd first start by observing that, there are still many regions in the world where people are trying to survive and trying to make a good life for themselves and their children. And if that is at stake, it may be harder to be too involved in ESG related topics, which seems to be more of a topic that there is a lot of attention for in richer countries. But it again sort of circles back to the I think technology together with economics is important. So if you would like people there to adopt this, then I think it's important to create an economically viable alternative that just therefore makes it easier for people to choose that, because they would choose that anyway. And so that in that way, I think, and as you pointed out, I do think that a globally coordinated effort is necessary for many of the, not all of course, but many of the ESG related topics is required. I think some thought into what can make it successful on a global scale, rather than it being confined to a small group of people in rich countries, I think seems very important indeed. So I agree with that completely.
Great. And also, to the last question here, Jules, we talk a lot about where things are right now, but if we look from, as an investor, particularly institutional investors, how do you see the dynamic changing, say, in the coming couple of years, with so many countries putting trillions of dollars, and the US being one of those, into green infrastructure, into the green economy? This has to play out longer term if we don't necessarily see it in the next year or so. What do you expect the changes will be in terms of ESG investing and investors and companies and their dynamic based on the investment that these countries are making?
Well, so I think the first thing that should happen is that there is more convergence and clearer definitions of what it is that we mean. Because one of the problems that we face now is that as soon as large budgets and large amounts of money are allocated to particular topics, there are a lot of people that are going to pretend that they fall on that topic too, even when they don't. And if we don't have our definitions straight, and we cannot measure, and we know what it is that we're talking about, then we can mention these very large numbers, but if they're not actually put to use where you would like them to use, to be put to use, that could be a problem, right? And so one of the, so I have some academic work, and is one of the more unfortunate features maybe of the financial sector is that there's free entry of charlatans, right? And so it's not that hard to enter that industry. Now, we can have a discussion, which the paper does, about actually how harmful are these charlatans, particularly for consumers. That's another important question to ask. But it is true that if now there are large resources, and by calling yourself ESG, you can potentially apply for those resources, and who's going to measure that you are? And so if we see the disagreement in the ESG rankings and the ranking methodologies, which, as I pointed out earlier, I mean, the fact that we have so many subcategories that we're trying to aggregate, the probability that we're going to end up with a different answer is almost given, because who decides how we aggregate this, and therefore who falls into the right versus the wrong category. And so if we don't solve that problem, I'm worried that could be a cause for people losing attention for because people start to say, yeah, but do we really know what it means? Do we really know whether it has any effect? And so that's what I meant earlier when I said setting concrete goals with measurable outcomes. That really helps things going, because if we reach certain milestones by particular periods of time that are agreed upon milestones that are and economically feasible and measurable, I think that is a way to keep things going and for it not to disappear as a fad. So I think that's important. So, and just as a small plug, I mean, because I think these important economic trade-offs in business and societal decision making, a colleague of mine at Stanford, Jonathan Burke, and I, we are going to launch a podcast in which we're going to discuss these economic trade-offs a little better, so that people can make well-informed decisions, business decisions, also that relate to ESG, but several other topics. And then as one final comment, given the fact that I think that the solution to a lot of the problems is technological, I really think that the assignment for the young generation is fix the climate problem through scientific and technological innovation that is economically feasible. So to achieve that, we need, I think, an increased focus of young people on learning these tools that allow them to actually solve these problems. And so large investments in STEM-related fields and economics, and coming together and really trying to find solutions. I think that raising the social awareness was a very important step, as we said earlier. But I think that just raising awareness for an issue isn't in itself going to solve the problem. We've now reached the point where we can lever all of that social awareness and do something with it, and actually make some technological progress and solve the problems. That will be the most desirable step forward, I think.
And in terms of, you mentioned solving problems here, we know that we have COP26 coming up, and there have been a lot of conversations around what's going into it, as well as what's going to be the output. What are your thoughts around what we can expect off the back of that?
I think it's too early to tell that, because I first need to see, indeed, as you said, what exactly concretely is going to be done. And I think
those goals, right? Goals and priorities.
Yeah, goals and priorities. And I think at least having also agreement on the language on what means what, I think is important. I think there's a little bit of confusion on that now. And again, I think that even though it may seem that in the short run that confusion can be helpful, at least to some people, I think in the long run it harms the cause, because I think that creating consensus and clear definitions on and clear priorities and goals that together we want to achieve seems to me like the way forward. Yeah. So I hope we can reach that.
So great information here, whether we're talking about businesses or even governments that are prioritizing and that are in funding and investing in these initiatives. First of all, prioritizing what's most important, what you can do, setting goals and milestones, and really creating those clear definitions across the board, whether you're corporate or a government. And in terms of thoughts around whether to invest in continuing to engage or to disengage and divest. When there's no cost, no benefit, you stay at zero. So there's really, when we can see no benefit in disengaging as investors with companies, then everything stays at zero. We don't see the progress that we need to see. So great insight there.
Yeah,
raising awareness.
Yeah, so sorry to interrupt you. So yeah,
sure.
I do think that what has happened so far has been effective to raise the awareness. So in that sense, there has been a benefit, because I think that raising awareness was an important first step to get that done. But now that the awareness is there, what are we going to do next?
Yes.
That's the key.
Absolutely.
Sorry, Keesa.
No, that's great. So, what's next? And you mentioned tech innovation, really creating change. So not just that behavior change, which is important, obviously, but moving to tech innovation and really having a globally coordinated effort to make sure that all countries, all regions, no matter where you are, whether you are considered emerging or considered developed, that everyone can really put forth and bring solutions to climate issues particularly. And I love the last point there, really encouraging youth to engage in scientific and technological innovation as a solution to our issues around climate and ESG. Jules von Binsbergen, thank you so much for joining. Jules of the Wharton School of the University of Pennsylvania. Thank you.
So great to see you again.
Great to see you.
Hope to see you again soon.
Absolutely. Thank you so much. And to our audience, thank you so much for joining. If you enjoyed today's episode, you can read a blog around Earth Day from David Harris. He's the head of sustainable business at the London Stock Exchange Group. And the document highlights how the financial sector is recognizing sustainability challenges. Just follow this link or scan the QR code on your screen now. And let's not stop the conversation here. If you like what you've seen and want to see and hear more, reach out to us on LinkedIn and Twitter with your questions, your comments, and your thoughts on topics you'd like to see us cover. I'm Keesa Schreane. Have a fantastic day and be well.